Have you ever thought about how to avoid taxes as a business owner? Maybe you're just curious and want to learn more. Regardless of why you're watching this, I am hoping it gives you some insight into what you can do as small business owners to avoid paying too much in taxes. This video will discuss the 10 things intelligent business owners do to cut their tax bills. Number 1. Getting documentation and records done. They realize that their time is more valuable. They also wish to be paid for their costs and not leave any funds on the table. They have to keep their bills, but keeping a record of all those annoying invoices is not exciting. Intelligent business owners use new tech to save hours and prevent getting it wrong. Using a digital accounting system is a must. Hiring a personal assistant and using applications like Auto Entry, Expensify, and Receipt Bank can also assist them to get what's legally theirs and lower their tax payments. Number 2. Don't claim Munch for rent and other costs. It might seem strange to claim less money to save on taxes. Even so, if you claim too much expenditure, you make less, so you pay less in taxes, correct? Not really. Let us just assume you own the building where you manage your business. When you sell your property, you must typically pay a 20% or 28% tax on capital gains. However, the rule states that you are only required to pay 10% if you sell the property when you sell your company. But most importantly, if you've been stating your total rent, you don't get this 10% of tax. Furthermore, when it gets to those other costs, intelligent business owners don't fall into the usual tax pitfall of spending. Assume $100 to save $20 in tax. Not a good way they could spend their money. Number 3. Getting help from tax experts. Most entrepreneurs know their accounting professionals are the best people to talk to about taxes. Cost accounting and taxes are two distinct jobs, but they have a lot in common. Most business owners who know what they're doing have both an accountant and a tax professional. This happens because they understand that accounting professionals are like general practitioners who are helpful and understand all the general guidelines. But tax consultants are like physicians who are experts in their area and understand the exclusions to the rules. So it's true that an accountant will inform you that amusement is not tax deductible. But a tax lawyer will generally find ways around the basic guideline that amusement is not deductible. Number 4. Developing a strategy for taxes. Smart business owners also have a strategy for how they will pay their taxes. They realize that if they don't take the time to organize and plan for taxes, they'll probably end up paying extra than they ought to. By making plans beforehand, they prevent the most common tax blunder, which would be trying to plan for taxes after the fact, which doesn't work, or not preparing at all. Number 5. Using available tax allowances. I haven't met a smart business owner who hasn't asked me about tax-free revenue and allowances. They appear to enjoy the reality that these allowances go to waste within a year if they aren't utilized. Furthermore, they use money that one's children and spouse are given. Have you heard that even if you add up the allowances for income tax, capital gains tax, cash reserves, and dividend income, you get over $28,130 in allowances in 1 year? This is only the beginning, and if your partner or kid doesn't even use their allowances, you could have up to $84,390 in tax-free income. Number 6. Tax-effective employees rewarding. When it comes to paying their employees, optimistic business owners do more than pay their salaries and taxes. They use authorized share plans and honors for staff suggestions to engage their staff and give them money tax efficiently. There are 2 types of honors for employees: encouragement awards for great ideas, or to thank your workers for going above and beyond, and financial benefit awards for ideas that will assist your company to save or make a profit. But just before you pay your employees a salary that doesn't have to be taxed, you should know that, like all tax breaks and exclusions, there still are circumstances to fulfill. Talk to a tax expert initially. They also use different share option plans, such as the Enterprise Management Incentive Share Option Plans, which are tax-efficient ways to reward employees. What makes this good? Since if employees meet the clear regulations, they only have to pay 10% tax when they sell their stock rather than 20%, 30%, or 40%. But as always, be careful as these laws come with some conditions, and always ask for help. Number 7. Asking for significant tax breaks. Even though they are preoccupied yet constantly searching for another issue to solve, such entrepreneurs know that HMRC provides them with many tax breaks. They don't overlook getting them because of this. Consider being able to be reimbursed for $230 even though you only spent $100, or even obtain funds from investors while ensuring somewhere between 30% and 60% of their money is safe. Okay, that's exactly what the Research and Development Tax Relief and the Enterprise Investment Scheme, or EIS, and Seed Enterprise Investment Scheme, or SEIS, give to business owners. Most company owners don't take advantage of these breaks, but not the smart ones. Number 8. Accepting tax-effective pensions. Smart business owners think about long-term and prepare for their retirement in a way that saves them money on taxes. Therefore, instead of simply putting money into a retirement account for which they receive a tax break and abandoning it over there, they use SSAS or SIPPS to use the funds to their advantage and get a second tax break. The money from these retirement funds, which must follow definite regulations, is then used, for example, to purchase a commercial estate, and the rental gets extra tax breaks. Not terrible, huh? Number 9. Paying less tax when selling their business. By making sure they can get a 10% tax rate, these company owners prevent paying 29% more tax when it's necessary to leave or on their investments before starting their next company. They sell their stock rather than the investments in their business, or if the purchaser is focused on the assets, they start moving the investments into some other company under certain settings, and afterwards sell shares in this startup entity. This gives the purchaser and seller the best of both scenarios. So why should you sell shares and not the assets? Because the investments belong to the business. It will have to pay, say, 19% in corporate tax if it wants to sell the assets. The business owner will then have to get the money from the business to go on that expensive trip or purchase the yacht. Let's just be cautious and say they pay 20% of their income as taxes. That's a possible tax of 39%, not just 10%. Number 10. Preserving the relief for corporate property. Several entrepreneurs make the costly mistake of not organizing how their companies must be handed on tax-free after they die. Under certain circumstances, the regulations let your family members relish your life's work without paying taxes. However, if you lack a will or leave your company to your wife in your will, you're throwing away this expensive tax break. Smart business owners don't make this error, so their life's work doesn't go to waste. When they sold their company, they paid 29% less tax. So there you go. Here are the 10 things smart business owners do to cut their tax bills. Please keep in mind that you should always talk to a tax expert before doing anything with your taxes. Thanks for watching. See you in the next one. And with that, I'm out.